the markets get a little bit of a reprieve for following yesterday's shenanigans with the CPI report that spooked one and all. But did we really get to a place where we can really and truly say that the markets can finally stop worrying about the Federal Reserve? That is, of course, the key question for us as we consider where this might be going. And that's what we're going to unpack here as we look at the event risk that comes at us from here. And we'll do a little bit of unpacking of how it was that we got our little reprieve today. And of course, yesterday we talked about the U.S. retail sales report that still comes at us with that release on Friday. So tomorrow, less than 24 hours now. But in the meantime, as we get ready, it should be helpful to see exactly what the markets did here and why. And then look beyond that retail sales report to next week, where the event risk only gets hotter. So, yesterday, the CPI numbers gave us a very discontented bond market. We can see that right here. The bond market sharply lower yesterday, and then, of course, today we can see that move has been wholly erased. We've essentially returned to where we were before that move occurred. Talked yesterday on the show about how that might have been the last large downtick in the bonds for a while, and indeed today not only was the move arrested, it was fully erased. So what happened there? We'll take a look, but before we do, here's the story from stocks. Yesterday we can see the markets initially sold off on the hot CPI number, only then to finish the day little changed. So not really taking the cue from the bond market there. And today, rallying. Part of that, of course, the data we'll discuss here, in part the announcement that reciprocal tariffs from the Trump administration may not arrive, if at all, until April, maybe. That, of course, diffuses a risk that they might appear much sooner than that. So we get a little bit of a rally, but ultimately stay within this narrow range that we've carved out since late November, early December of last year, sort of depending on how you frame this sort of congestive period here. But what certainly seems to be clear is that there's not a whole lot of conviction still, because we, of course, not only remain underneath that high, but we've only just closed the gap from that DeepSeek fiasco and nothing more. We struggled to even make a run at the secondary high here from early in the year. So a little bit of upside from the markets, but conviction still seemingly lacking. For the U.S. dollar yesterday, it initially strengthened on the data. Today, a reprieve there as well, selling off against the euro here. We're looking at 6E futures for the euro as a kind of stand-in for the dollar's overall direction, because, of course, the euro is its largest counterpart, and the general benchmark, the U.S. dollar index, is overwhelmingly tilted toward euro, because most of the legacy currencies that make up the basket are now the euro, like the Deutschmark or the French franc or the Italian lira. And so when we look at what's occurred here, yesterday the dollar tries to rally. It manages it against the yen, for what it's worth, even though it gave it away today just as the bonds gave up their losses and erased that. But in aggregate and overall, the dollar ultimately doesn't get much headway thanks to CPI, much like stocks don't get much of a downdraft. And today, as stocks extend, so too the dollar pulls back lower. So what is this sequencing and what's going on? So here is the CPI report that we ended up seeing that ultimately spooked everyone. 3.3% on headline inflation versus 3.1 expected. And indeed, this core number rising, whereas it was expected to come down from 3.2 to 3.1, and ended up not only not going down, but actually going the other way and unexpectedly accelerating. Unexpected acceleration at the number, including food and energy as well, the broader number here, 3% versus 2.9. And not surprisingly, that shook the market's expectation for how much the Fed might be able to cut rates. And so that's this sell-off in the bonds. Why were stocks and currencies more circumspect? Well, as we discussed yesterday and we'll briefly review today, it seemed like what was going on in the inflation numbers was actually not all that scary when you consider where the headline numbers came from. They mostly came from the goods side of the ledger rebasing, so the negative contribution from goods to CPI became smaller, and energy swinging from a marginally negative reading to a marginally positive one. But when we look at where most inflation actually lives, the core services sector, it went down. In fact, we can see here in the breakdown, this is the inflation that matters. This big, thick gray area, that's where the Fed's progress to 2% inflation will be made or broken. And what we see is that on this measure, we actually come in significantly. 2.62 percentage points is actually the smallest contribution from core services to overall CPI in years. And so what the markets took away from this was actually that the numbers probably don't change the Fed's calculus terribly, because the part of the equation where they have agency actually seems to be moving in their direction after these temporary and, for the most part, statistical adjustments work their way through the data. Now, more worryingly, what this rhymes with is a sobering set of PMI numbers that came out last week, suggesting that the U.S. service sector has started to significantly cool. And of course, that's the essence of why we get this sort of skew in CPI. Notice almost nothing for inflation for goods for quite some time. Food has been squeezed down. Energy is still very low, if now no longer negative. All of this is happening in core services. And then when we look at what's going on with the drivers of growth for the U.S. economy, we can see it's services with the strength, whereas the manufacturing side has been anemic and only just returned to growth last month. As ever, these PMI numbers are done around an axis of 50, where that's neutral. Above it is growth. Below it is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so what you find here is a significant downstep in this critical sector. And not only do you find it in the S&P global data, and albeit here it's more dramatic, but a parallel PMI data set, this one from the Institute of Supply Management, ISM, it also misses on its service sector gauge. 52.8 versus 54.3 expected. Not quite as dramatic. This gives us a 12-month low on U.S. economic growth, thanks to a steep come down in the service sector. This gives us a more modest come down, but still the weakest reading in some months. So as we look at this, in the context of these CPI numbers, the markets say, well, maybe the story here is, at least from the immediate Fed policy perspective, not a prescription to jettison rate cuts altogether, as the bond markets seem to be worrying about, because clearly the underlying economy, that is the service sector, its sole sort of pillar of growth and support, that's actually cooling. And what the CPI data marks is another step in that direction, following on from the PMIs, both S&P Global and ISM, that were leading us there already. We get a further reprieve today from the PPI report, and this helps to cement the sense amongst the markets, seemingly, that yesterday's CPI numbers were not what appeared at the headline, at least at first blush. So consider here the overall PPI number, the headline number, it comes in hotter than expected at 3.5% versus 3.2%. But after the revision to the previous month's numbers and revisions higher, it actually ends up unchanged. So it is higher than it was thought to be, but it isn't a step in the wrong direction from what was there in December to what was there in January. The core reading, again, excluding energy and excluding food, which is much more relevant for Fed policy officials since they can't exactly mandate global food and energy prices, that view is even better. So again, 3.6, higher than 3.3 expected, to be sure, but also a step lower after you consider that the prior month was revised to 3.7. So at least in terms of the direction of travel, wholesale inflation is telling us a story that is much more relatively benign than what the headline numbers for CPI suggested, and what ultimately CPI started to look like once we unpicked what was under the hood. Where does that leave us on Fed policy expectations after all of these gyrations? Well, now we are sitting at what appears to be about the wall for where hawkish rethinking of policy expectations could ostensibly go without the Fed fundamentally altering its posture. And this is why, when we look at next week's minutes from January's FOMC meeting, this becomes that much more of a live risk for the markets. So consider, in the wake of all this back and forth, where do we end up? We have one rate cut that's baked in for this year. 31 basis points is a bit in excess of one cut that's being baked in. So one cut at 25 basis points there, and an extra 6 basis points toward a second one. So a very small chance that we get two cuts this year. For next year, we're basically 50-50 on another cut at 11 basis points. The likelihood of one is just a touch lower than 50%. So on net, we're looking at 42 basis points now in overall easing through the end of next year. Now, why is this significant? Well, you'll notice this is about where we were when the markets were at sort of peak consternation in December. And that was, again, around this idea that the Fed may need to ease less than the markets want. That's this right here, this pullback. And the last time that we were here on rates, we were about here. So we are at this point aiming for less than half of what the Fed itself projected. Right here is the expectation for this year as of the December update of the summary of economic projections. The next update comes in March when the Fed has its next meeting. There's quite a lot of time now before the Fed actually makes the next adjustment, giving the markets lots of room to speculate. What we have then is from 4.4 to 3.9, that's 50 basis points this year. And from 3.9 to 3.4, that's another 50 basis points next year. In aggregate, the Fed thought that through the end of 2026, they would do 100 basis points in cuts. The markets now are, as we see here, at less than half that. And so when we consider then what could be happening, if in fact what this data is telling us, the CPIs, the PMIs, the PPIs today, if what it's telling us is the markets have moved to this hawkish setting because they're afraid the Fed doesn't have enough room to cut and are now close to 60 basis points more hawkish than the Fed itself, if we are to take this move at face value, then the next adjustment is for the Fed to do no cuts this year. With only a single cut that's priced in, the only place you go that's more hawkish than this is no cuts at all. And for next year, we're already there for the most part. So when we consider what this means, the question becomes, is this fine-tuning, going from 25 basis points to 50 in cuts, or to 75, or back to 50, or back to 25? That's managing the pace, that's managing the timing of when easing comes. But going from we intend to cut to we no longer need to cut at all, that's a tactical and strategic change in the overall direction of Fed monetary policy. And that requires all kinds of additional further forecasting, especially when the markets are this far offsides from the Fed itself. Now, this is where these minutes become so consequential. The Fed told us in January an outlook that was very measured. All it did was basically tell us that on the whole, we are just going to sit and wait. Consider, inflation remains somewhat elevated. The unemployment rate has stabilized at a low level, and labor market conditions remain solid. And those were really the only edits. The Fed here clearly is non-committal and wants to wait and see. That's what we heard in the press conference from Chair Powell after this meeting. It's also what we heard from him in testimony in front of Congress, now both Senate and the House, this week. This does not sound like a Fed that's changing its mind about the overall direction of travel, and instead is more so trying to fine-tune when it's going to make the next move to ease. That would suggest that this right here has reached about as hawkish as it can go, give or take. If the minutes then come out from this January meeting and tell us the Fed remains committed to the direction, they are not rethinking the path to where they want to end up, they do want to be cutting, what they're trying to figure out is when to do the cutting and how much of it to do. And if their cutting cycle is entirely off the table, well, that doesn't seem to be in the cards, unless, of course, Fed officials start to talk about it. If the minutes do suggest that, then, well, we could have another big run-up in yields. But if not, this appears like it's reached something of an exhaustion point, or at least very close to it. At the same time, the other big update on economic data next week will be conveniently enough, the next set of S&P Global PMIs. Lest we lose sight of what truly matters here, this cool down that we just talked about for the US, it marks convergence with what's been going on in the Eurozone and China, the other two major economies. So we talk a lot here on Macro Money. The Eurozone, China, and the US make up 58% of global GDP. And the other 42% are, for the most part, vendor economies that need demand from the large three in order for them to have a sizable or at least a meaningful contribution. Those incoming PMI numbers for February, they're going to tell us more on this story where the Eurozone and China have been slowing since basically the end of the first quarter, beginning of the second quarter last year. And it's been the U.S. holding up the entire global economy, maybe until January, where we're converging toward slower growth. And if that's the case, then the signs of weakness we've now seen in CPI, the confirmation of that underlying softness in PPI today, all of that seems to suggest that not only is the economy on weaker footing and there is a global recession risk that might be brewing if this continues, because if the U.S. slows, there is no safety net from the other major economies, but most importantly, that this is now incorrectly hawkish. And what all that boils down to then for asset prices starts to look like bonds that are relatively cheap and have perhaps room to break out and extend higher as the markets start to consider that the Fed is going to need to do a lot more easing downwind, even as they resist now. And for stock markets not to necessarily love that news, because the easing will not be fast coming. Again, the next Fed meeting is in March. They would need to significantly rethink their perspective if they were going to speed things up aggressively. In the meantime, the global economy would show significant signs of wear and tear, and this top may well hold with a turn lower. And of course, if the markets are speculating on Fed easing before the Fed really gives them the support and the confirmation that, in fact, it sees things the same way, the speculative element here might well drive down the U.S. dollar as the markets seek to push the Fed toward a conclusion, or at least anticipate that it will get there, which probably means a weaker U.S. dollar once next week runs its course. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go from there. I'm likewise on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.